Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Oli Hammond from Fuel Ventures to talk about the Fuel Ventures EIS funds. Hello, Oli. Welcome to the studio. First time in the chair. So we're here to talk about the EIS funds. You offer, I guess, two flagship EIS funds. For those who aren't familiar, what are they?
Yeah, absolutely. And thank you for having me today as well. I'm really happy to be here. So we have two core EIS funds that we deploy. The first fund is what we refer to as our scale-up fund. It's a first ticket EIS fund. We do 10 to 12 investments a year. And then we also have our follow-on fund, which is a 5 to 8 ticket fund that we deploy once, maybe twice a year, but purely into portfolio companies that we've backed before and that we've worked with for a period of time. So we've got a level of confidence in their ability to grow further.
Both funds managed by Fuel Ventures. For those who don't know, who are Fuel Ventures and what's your role there?
Yeah, absolutely. So I am a partner at Fuel Ventures. I'm specifically a partner on the scale-up and follow-on funds. I deal specifically with EIS. We do have an SEIS team, but I'm kept slightly separate from that team so that we don't have the conflict of interest between the two vehicles, although I do obviously work very, very closely with them. We invest into a pretty generalist portfolio. We focus on marketplaces, platforms, and SaaS model businesses, both B2B and B2C, which is broad, but broad by design. At the seed stage, we want to make sure we can diversify really well. We want to be able to move with the market, and we don't want to become too pigeonholed at that very early stage. We have about 75, 76 companies in that fund. The reason I'm splitting between the two is because we're closing a couple of deals right now. But we have about 75, 76 companies within that portfolio, all investments we've made since 2016.
And you've made, since inception, a number of investments now. I think AUM's reaching sort of 400 million.
Yeah, AUM at the moment is about 400 million, if I remember rightly from the last count. I don't have to stick on that side of things. I deal with the companies, so I deal with all the fun stuff.
So Oli, on that topic, turning to some of the companies, so you're focused on those three sectors, SaaS, marketplaces, platforms. Any interesting examples of companies you've backed recently?
Yeah, absolutely. I mean, this year we've backed, I think, about 11 companies so far. We've got a couple more in the pipeline, so we're going to close out the year hopefully on 13, maybe 14 companies. A couple that we've done earlier this year so that we can start to see some of that early traction. We did Healsgood. Healsgood is a platform that works in the locum recruitment space, a space that historically recruitment we've been pretty adverse to. So what they do is they work with locum recruiters. Locum specifically deals with healthcare professionals, so putting people like anything from nurses all the way through to doctors, through to paediatricians, through to into our hospitals, whether that be private or whether that be public. The NHS spends about 12 billion a year on locum recruitment at the moment, and that is as simple as moving people between different hospitals to fill shifts. There's a whole industry that's grown up around this, locum recruiters who specifically fill those shifts within hospitals. What Healsgood does is it works both with the recruiters through their Cario product and through NHS hospitals with their Flexo product in order to make sure that we're filling those slots very, very efficiently. But also that we can these recruiters can push out to their database of thousands of healthcare professionals, but also provide the background checks for those professionals as well to make sure they're meeting the regulatory requirements of that market. That's a business that when we invested was doing in the region of £600,000 of ARR, is now a business that's doing about 1.4 million of ARR and has a signed pipeline going live next year that takes that adds another million to that ARR, so it's growing very, very quickly.
Any other examples?
Yeah, so we also invested earlier this year into a company called Damisa. Damisa is run by a guy called Jordan. Jordan was actually originally one of our founders from another portfolio company, a company called Volt, which he grew to $350 million valuation. He left that company and founded Damisa. Jordan's someone we've got a great relationship with. He's the guy that loves the startup stage. That's really his focus, and so he launched Damisa. It's a stablecoins platform for international transactions, and that's a business that we invested into pre-revenue and is now fast approaching $1 million of ARR. So growing really quickly.
It's one of your stars in your earlier
portfolio. Volt is one of part of the early open banking platforms. Has done really well for FE3 so far on paper. I haven't got any cash return from that yet, but is doing really well on paper. So is one that we're really happy with. Had a really good relationship with the founders of that business.
I think there are a couple of businesses that have come from the Volt stable.
There is. There's also another payments business this year called Velocity, who we've backed who came from some Volt alumni. Fintech's a really big part of what we do. We love fintech as a business. It's something that's done really well for us in the past. And so we are always really happy to back fintech businesses within our portfolios.
Are you finding that now, Fuel being sort of 10 years in, some of your previous winners are now coming back for a second venture?
Yeah, they're coming back for second ventures and also investing in us as well, because not only have they taken money from us, but they've worked with us. They know what we're about. They know other founders in the portfolios. They've got those experiences as well and access to those people. And so we do have a couple of founders who have given us money as part of that as well. Which for us is a massive pleasure. But mainly what I'm interested in, what I'm looking for, are the founders that are going and building their next companies as well, and the ones that we've had really good experiences with.
And then, so turning to some of the more established names within the portfolios. Any highlights there? We mentioned Volt, I think
we mentioned that. I think it would be really important to mention Abingdon at this point as well, which hopefully is soon to become the biggest company within our portfolio. We invested originally back in July 2022. That was in a pre-revenue business. It was a roll-up business, rolling up mission-critical software. We took a real chance on Ash, who was the founder of that business, on the basis of his experience. Ash was an investor at General Catalyst, leading European software investing. He led their investment into Visma, which is a Scandinavian-based roll-up business. I think probably worth about 25 billion at the moment. It's privately listed, but there are rumours that it might go public at some point soon. He's then brought on some really, really fantastic people onto these boards, including the founder of Roper Technologies, which is I think probably worth about 50 or 60 billion roll-up business.
One of the leading roll-up software
businesses. Alongside Constellation, definitely one of the leading roll-up businesses. So some fantastic people there. We really like the roll-up space. That's an area that we've looked at, and it's quite unique for us. There's not a lot of VCs that touch that space. I'm not entirely sure why, but it's something that we like to dabble in a little bit as part of our portfolios when they're dealing with tech. Ash has done fantastic there. That's a business that's fast approaching $40 million of ARR within sort of 3.5 years of our original investment. So growing really fast, and that's somewhere where we see real unicorn potential within the next couple of years.
I guess the ultimate goal is exits.
Absolutely.
So I guess you've had a number of exits in the past, but maybe past 18 months or so, not so many. Exit environment's been a little bit challenging.
Yes.
What does it look like at the moment?
I think the exit environment is still semi-challenging. What I would say is that as we've matured as a fund, our strategy around this has developed as well. Super important part of what we do. And in the early days, we were focused incredibly heavily on deployment, good deployment, like all funds should, really, making sure that we're getting access to the best companies, making sure we're getting access to the best people. As we have grown, we are now becoming more and more dedicated to more efficient routes to exit. Just beyond the standard IPO, fingers crossed for a trade sale routes that I think when you start out with, that's sometimes what you can end up gunning for. So we've done a lot of work recently on things like secondary transactions, which for us is a super efficient way to exit our positions within businesses. And we've done that with companies like Arbolus, where we've had secondary transactions. And Shiv, one of the other partners, has really been leading on that from our side. So we're putting a lot more focus. We're pulling focus away, I should say, from these sort of maybe IPO markets to what can we do to drive good cash returns for investors, and secondaries is a great way for us to do that.
It's definitely becoming more popular in the industry.
Absolutely. Yeah, absolutely. And there are more and more funds dedicated to that. And we just need to make sure that when we approach it, we're approaching it with level heads. These markets can be relatively well discounted for the buyers. So we need to make sure that we are, whilst we want exits and we want cash return to investors, that we are also providing them with good value. So that's what we're spending a lot of our time focusing on right now.
Good. And so turning to risks, how would you describe the risks within these two funds?
High risk. And the way that we structure the funds is that we do structure the follow-on fund as a slightly lower risk fund because they are people that we have experience with. They're people that we've worked with, worked alongside. So absolutely, I would say that that the follow-on fund represents a lower risk fund. However, both of these funds should be considered high risk. These are early stage illiquid companies. And what we are aiming for with these businesses is significant growth and a significant increase to shareholder value. So, but we have put them as two separate funds because the risk profile is slightly different and it makes sense to do so for investors that have different appetites.
Sure. So, Oli, summing up everything we've just discussed, for those who are looking to back an EIS fund this year, why should they be backing Fuel Ventures?
It's a great question, and mainly because it's it's quite a convoluted market. And there are a lot of great offers out there, great funds out there. Why Fuel Ventures? For me, it's pretty simple. The first is we've got a really good ticket size, which sounds irrelevant in a lot of cases, but it's not, because what you get with really good tickets is really good access. What we allow companies to do is to get moving, to get working, rather than to get cat herding. And that's a really important thing, right? If you can close rounds efficiently and quickly, you win better deals.
So by that you mean really there are some funds out there where you might need 2 or 3 different funds to all line up, all their investor committees,
or some angels, or some herding the cats.
Whereas you can complete a deal. If you like a deal, you can complete it.
We can complete a deal and we can offer either the full ticket or the lion's share ticket. And actually, usually a lot of these companies have some angel investors floating around them that can come in for the rest of the money, and we can do all of that. We can get it together and we can do it relatively quickly, which is really, really beneficial for the companies, but also beneficial for us because we get great access to great deals. The thing that I would say as well is that we are just getting better. We started out in 2014. Mark started out in 2014. I joined in 2019. We did our first investment in very late 2015, 2016. We're 10 years down the line now. And every fund is, in my opinion, is getting better and better and better. We have more experience. We have more grey hair. We have more stress. But we've worked with a lot of founders. We have built a good reputation in the market. And having that is vital. This market isn't about luck, it's about access. It's about making sure you can access the very best founders, the very best companies. It's about making sure that when people talk about you, they talk about you in a positive light, and not everyone's going to, but it's about getting the balance of public opinion working with you. We've got great founders who support us massively, who give us access to fantastic deals, who give us fantastic introductions. We've now got that ecosystem that's giving us access to better and better quality deals. And so the best is yet to come.
Fantastic. Sounds good. Well, Oliver Hammond of Fuel Ventures, thank you very much.
Thank you for having me.
If you're watching on YouTube, please press like and subscribe to the channel for more.